Good Thursday afternoon to you. Welcome to the Jon Sanchez Show on News Talk 780 KOH. It's a pleasure to be with you and a pleasure to be with my co-hosts. Around the horn we shall go. I'm not seeing much of a smile on his face this afternoon, but let's see if we can get there. It is. There it is. Dwight Millard,
There
Highlands
we go.
Mortgage. You okay, buddy? You okay?
I'm doing fine.
Okay. Just want to make sure. I mean, nothing's happening in mortgage rates due to the bond market. Nothing happening. So,
Yeah.
all right. Just want to make sure. It's like, did you know something I don't know?
No, it's just a little quiet, but I mean, they're blaming it now on just the government shutdown. There's another yawner, no data, no anything.
Right, exactly.
I guess we all should just take off, right?
Right. Yeah, that's true. Cory Edge of Realty, how are you, my friend?
I'm doing fantastic.
Good. Mr. Low Key, I love it. Always smiling. All right, folks. Well, thanks so much for joining us. We're going to recap today's stock market activity. A bit of a rough one on the Dow side of things. Okay on the NASDAQ and the S&P after record-setting day after day, but we didn't get that today. I'll give you an update, of course, of everything that happened, and then we're going to get into our real estate topic. We're going to continue what we started on Tuesday because we, as always, ran out of time. And our topic on Tuesday was, you just inherited a house. Now what, right? Again, this is all centered around what we've been discussing quite frequently on this program, which is the biggest wealth transfer in history by many economists is going to occur starting next year through, depending on whose numbers you look at least for the next 10, 15 years. Right? Dwight and I's generation, the baby boomers, passing wealth on to our kids and so on and so forth. And again, it's going to be one of the largest ever in history. Trillions of dollars is going to be in the real estate side. What was the numbers, guys? Like 14 trillion, right? Something like that. I think we touched on Tuesday. Of that is just going to be the real estate. So the odds are many of you are going to be inheriting real estate from your parents, most likely. But before you think you just hit the lottery and get all excited, we want you to step back a little bit. And if it hasn't happened, this is a great time to learn about what this entire process is about. What should you really do if you inherit the home? Should you keep it? Should you sell it? Should you rent it? Right? Those are your three primary options. Well, today we're going to continue our discussion, like I said, that we started on Tuesday on the financial, the tax, and the emotional decision, because unlike any other form of real estate, this does have an emotional piece to the puzzle. So we're going to talk about that. Last Tuesday, we got through, you start with reality. Number 2 point we touched on was the immediate steps after inheriting the home. And then we left off on point 3, which is understanding the stepped up basis. So we're going to recap real quickly what we touched on point 1 and 2, and then get into our fresh topics. But again, the odds are, based upon the great wealth transfer that many are predicting, that again, at some point, you're probably going to be one of these people inheriting money. Or if you're on the parent side, you're going to be moving this real estate over to your children, the grandchildren, etc. So it's going to be a great learning lesson for everybody. We're excited to share it with you. But in the meantime, let's get down to the stock market side of things. So if you notice, we've been firing some shots across the bow, as the saying goes. Watch this market. Things are a little frothy in many investors' minds, and many strategists, many traders' minds. It just takes a little bit of this, a little bit of that, and we can start to succumb to some selling pressure pretty quickly. Well, today we did that, at least on the Dow side of things. We recovered on the NASDAQ and the S&P, but this market is becoming very fragile right now. President came out today. Again, we're in today's the 9th day of the government shutdown. As I shared this morning on my stock updates, I feel, this is my personal opinion, I'm feeling that investors are starting to get a little bit of anxiety, right? 9 days, they're not seeing any economic data, as you'll find out when Dwight gives us the mortgage side of things. People are just kind of getting a little bit of, okay, how long is this thing really going to go on? Now, as I was just sharing with the boys before we started, I got a news headline that came out at 2:55 from the Bureau of Labor Statistics. They have recalled their staff to ready the September CPI report by month's end. That's according to Bloomberg. So, that's okay. So they're going to get the staff in there and get the CPI report ready for the end of the month. So, here we are, the 9th of October. Is this just a preemptive move? Do they know something we don't know as far as the government shutdown coming to an end? Who knows, right? But I thought that was very interesting to see that headline. But back to the nervousness of the market. So we're, again, 9 days. Remember, our last one was 33 days that the government was shut down. So we've got a ways to go if we're going to match and beat that one. So we're 9 days into it. We're not getting any economic reports. Market is kind of looking for some information right now, looking for some direction. Again, the concerns keep coming up about AI and valuations and circular accounting, all the things I keep talking about every single day. This is what we're talking about today. Kind of felt that way. That's like, okay, people starting to get a bit nervous on things. But again, that's just today. We'll see. There's no trend developing by any means. Just again, be cautious, have a defensive strategy in place, be ready to go if again, we get into these situations, where the market can move south on you very quickly. It's funny, guys. It was about 9:00 last night. I was getting ready to go to bed. And I was looking at my phone, setting my alarm, and I looked at just wanted to look at any, last minute news stories, and I had deja vu. There was a picture of a 23-year-old kid that he graduated Columbia at 19 years old, went to work for Elon Musk, I think at Tesla or at X, and now he's launched his own AI company. And you can still see the pimples on his face, but he's now a billionaire. And I took a screenshot of that and I sent it to Jason and I said, if this isn't reminiscent of the .com era, remember that, guys? I mean, these kids some of them weren't even 21 years. I remember joking about that on the radio show. There were some that weren't even 21 years old, not old enough to drink. And they're like instant millionaires overnight, hundreds of millions of dollars. And now you start seeing some of that going on with this new boom of the AI side of things. And I just thought it was kind of interesting to see that happening, but a lot of similarities going on there.
John, I was going to say, John, go back to that era. These kids, did they get in before the IPOs? Were there, hey, I'm going to give you.
That's a great question.
What gave them, remember, all of a sudden it just, there's the wealth.
I reflected it, what happened with Jason yesterday on the show, because I was obviously in the thick of things at that point. So I was living in Bakersfield. I started on the radio station there. I still had the brokerage firm. I just went independent in 99 and started on the radio station there in 97. And then they gave me my own show at about, I think, 1998, and then stock updates, very similar to what I do now. But in 99, they moved into prime time. I was at 5:00. And so I had a massive, huge audience, right? And I remember telling the audience that, watch what's going on in this whole .com era, right? Because once again, to relive that, Dwight, it was all you had to do. Literally all you had to do is put .com at the end of your corporate name, and people immediately thought, oh, this is internet related. Let's buy their stock. I mean, as stupid as that sounds in retrospect, that was it. So what did I do? I formed a corporate California corporation called StockTalkAmerica.com. And I was the only shareholder of it. And I issued myself, I can't remember the exact number, but it was some crazy number. I don't know, 100,000 shares, worth 0.001 cent, right? But I had it, in my office and stuff, and I still have that. And what did I do? I call it StockTalkAmerica.com, right? Just on the whatever hopes, that's how crazy things were, that I had .com in my name. Maybe somebody would want to come to buy the rights to my radio show or something, but that's what it was, Dwight. It is, you put .com, people would jump on it. And then, so these guys would start these companies with nothing, no earnings. Matter of fact, you think, some of the burn cash rates are high right now with AI companies. It ain't nothing, compared to what we saw back in the .com era. So they'd start these companies with nothing, start in the basement, whatever they did, put .com on it. Next thing you know, they're losing hundreds of millions of dollars. And next thing you know, they're going on the stock market. And then investors, oh my God, it's .com, it's an IPO, grab it. And then the stock runs up. These kids overnight are becoming, again, multi-millionaires. And then what happens? Reality sets in, sometimes a month later, a couple months later, they're like, hey, we're out of cash. Can we do a secondary stock offering? And of course, at that point, the .com bubble began to burst. And when everyone was like, no, you had .com on your name, we're not touching you. And then they just disappear, go bankrupt.
And how many of them cashed out?
That's right.
Very few.
Yep.
Oh, well, I mean, a lot of them.
No, a lot of them did. They made the money in the IPO, Corey, and then the shareholders got screwed as always. Yeah. But I think what you're referring to, shareholder wise, how many got out? Yeah, not many.
Well, the shareholders, and then depending on the lockup periods and whatnot. But yeah, there were a lot of people just like today that believe their own hype. Like, you know what I mean? And so it's very interesting.
Yeah, exactly. But yeah, Dwight, it was fun to reflect back. I hadn't thought about those days, like I said, until yesterday. So it's funny you bring that up.
And there's still a few out there,
I saw a stat today because, I'll dig it up at the break. I'll bring it up, but basically it's saying a massive percent of the market is going up because of a very small percentage of the AI dominated countries or companies, right? And, you start looking at that and you go, once again, we're starting to get top heavy, right? We've heard the term Magnificent Seven, right? Remember the last couple of years, you've had the majority of the market gains were attributed to essentially 7 companies, the Googles, so on and so forth. But to my point in this article, it talks about back to that era, Cisco, right? Very prominent, market leader right now. They were down to like $2 in that .com bubble burst, and they were one of the survivors. So once again, the old analogy comes back to, it's he who has the strong or the biggest balance sheet. They are the ones that survive. And it's going to be the same way. I'm telling you, it's going to be the exact same way with this AI situation, because there's so much froth right now. There's so much money, much more money, much more capital involved in the AI ecosystem, right? Because what was different in the .com? Well, Dwight, you could have launched a .com in your bedroom, and you don't have any bricks and mortars or anything. Not the case here, right? Jensen Huang, the CEO of NVIDIA, was on CNBC yesterday, and he goes, look at, just to get a 1 gigawatt data center up and running, you're talking $8 to $10 billion. And now they're bringing on these, again, 10 gigawatt data centers, right? Massive ones that are there. You've got serious capital involved. And, Cory loves following the capital trail as much as I do. Where's the capital coming from? Venture capital funds, basically private equity money, et cetera, right? So they lend it to XYZ company to build it. There's another party, the actual construction company and the builder of it. And then you go down the food chain, and guess what? You take let's say an OpenAI or one of these other companies. Do you think that Cory, you're the real estate guru, did OpenAI, if they're building one of these massive data centers, just to pick on them, are they buying that real estate? Those data centers?
They're probably leasing them, I would assume.
Exactly.
Yeah, of course.
Why? They're not burning up capital doing that. But most importantly, if things fizzle, which they will, and some of these data centers and these companies are going to fail, you're going to see a lot of empty data centers, in my opinion, down the road. What do? They go bankrupt, or they write it off, right? It's not like they have to sit there and sell the real estate, and they didn't have to cross-collateralize every asset they have, which none of them have any assets.
They can get out easy.
Qualify for a mortgage, right?
Yep.
Yeah. So it's that chain where it starts with the private equity, the venture capital, who, really funding the money at very high interest rates. I mean, I'm shocked to see some of these interest rates. And then they lend it, for the construction side. And then you get somebody else that'll come in, some of the real estate investment trusts, et cetera, that'll come in. They'll actually buy, foot the bill for the entire construction. They'll cash everybody out. Now it's on their balance sheet. And then their hope is they turn around and lease it to, the OpenAIs of the world or some of these other companies. And even the chips, Dwight, even the chips in these data centers, most of them are leased from NVIDIA. They don't even own the chips. What skin in the game do they have?
Yeah.
Have you looked to see the amount of money that OpenAI is borrowing? I mean, it's nothing for them to go out and go, oh yeah, we're doing a debt offering for $500 billion, $500 billion. Investors aren't blinking an eye. It's like, oh my God, this thing's just going to be the most phenomenal. I hope it is.
Isn't it? It kind of goes to the point.
Can I pause you?
Yeah.
I just looked at the clock. My goodness, I'm so behind. Pause 1 second here. Let's turn it over to the wonderful Kristen Snow, right now traffic center. Sorry, Kristen. Welcome back to the Jon Sanchez Show on News Talk 780 KOH with Cory Edge of Edge Realty, Dwight Millard of Synergy One Lending. Synergy One. Whoa, where'd that come from? How about Highlands Mortgage? Yeah. My goodness, flash into the back. Into the back. All right, 243 loss on the Dow's. How we finished up is 0.5%, 0.52 to be exact, with a close of 46,368. Nasdaq lost 19, and the S&P down 19 also. Oil, $1.15 give up, 61.42 a barrel. That run on gold, broke above that 4,000 mark yesterday, or last couple days. It came back to below the 4,000 mark today, 76.50 an ounce, down $93.90 an ounce. And Mr. Millard, a 2 basis point increase on the 10-year, 4.15 is our yield. Educate us on the mortgage side, my friend.
Here we go. Yawn. No reports. No bond trading. So the 30-year mortgage is exactly what it was on Tuesday, 6.38. You got a couple basis points improvement on the 15-year to 5.88, and then the FHA VA is at 6.05 and 6.07. So a little bit of improvement on those fronts, but the 30-year fix just holding steady.
Yep, exactly.
Yeah, nothing.
All right, a little bit of local real estate news. Thank you, Dwight. A little bit of local real estate news reported this morning in the Reno Gazette that the city of Reno has approved ADUs. Mr. Edge, tell us about that. Good, bad, or indifferent?
It depends on who you're talking to. But accessory dwelling units, this has been going on for I don't know how long. So last night was the final vote, I suppose. So accessory dwelling units, I didn't read it, John, as far as the in-depth statutes, but basically, if you have a house and you have enough size and you have enough parking, now you can build a
square foot lot minimum.
Is that what it was? Yeah. And they usually have a parking component in there. So now you can build a separate structure on your property for your mother-in-law, or they're going to allow rentals, and they're going to allow short-term rentals. And I think if I understood it correctly, kind of unfettered use of short-term rentals. So they are talking about going in and getting a handle on that, because It always scares me when they talk about, oh, we're going to allow these ADUs, and then they compare it to people that want to come in town like they do for a hotel room. Like people buy their house in neighborhoods, so they're not staying in a hotel room. So now you're going to let my neighbor build something. But don't get me started on it. I'm not a huge fan of it. My cynical side is if you build more houses, more people will move here, and that's not what I'm looking for. But anyway, we'll see.
Isn't this just the opposite though, Cory? Because we've done a lot of shows on ADUs. Remember a few years ago down in the Bay Area, they allowed these, and everyone was like, "Oh my God, finally! I can do this." Isn't it more so validating that the reason they're allowing this is because that it is too expensive to there's a housing okay, let's start at the beginning. There's a housing shortage. So Dwight can build an ADU in his backyard for whatever, $100,000. He can turn around and rent it out to Cory Edge, who, is a single guy, he doesn't have any family, blah, 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 blah. And that's going to ease some of the pressure on the housing. Isn't that kind of the underlying gist of it?
That's the underlying gist. My cynical opinion is we don't have a housing problem. We have a people problem.
Okay.
There's too many people. That's just me.
That creates the housing problem.
We don't have a housing issue.
Yeah.
There's some of the things to remember. There's certain neighborhoods you can't do it in. If you have CC&Rs restrictions, I don't care how old they are. I live in a neighborhood with restrictions from 1948. You're not going to be allowed to build them there. The state and the legislature and even the local government cannot override existing property restrictions. So there'll be lawsuits over it, but it's not going to fit every single neighborhood. Let's put it that way.
Okay. So your advice to someone that says, okay, I fit the criteria. I've got 5,000 square feet plus. I don't have an HOA, but man, I'd love to, build something and get $1,000 a month rent. What's your advice to someone like that?
Run the numbers. So the first thing is, if you hit all the criteria, meet with the contractor. What's it going to cost to build this? So if you think you can rent it for, let's call the hypothetical $1,000 a month, but it's going to cost you $750,000 to build, well, that doesn't make much sense.
Yeah, it's not going to make sense.
You still have to run the numbers that way. You can also, I guess, kind of look at how it would potentially increase your property value. As Richard Lace would let it, and property taxes, all this stuff. Richard Lace would let us know that if you think it's going to increase your property values by X, he as an appraiser would have to go out and find other similar properties that have ADUs. You don't just get to, spend $500,000 and then add $500,000 to your value. Doesn't work.
John, I need to make a very important point, and Cory, jump in on this. Remember, in the state of Nevada, it's cost minus depreciation is how they come to your tax bill. Okay, John? So the older the house, the lower the tax bill in theory. The moment you go get a permit to add on to your house, boom, you're back on you're on your tax, right, Cory? Your tax base has just changed from that point. So the moment you go pull a permit, you just wiped out your benefit.
Let's run the numbers real quick. So let's say I bought a house, whatever, 10 years ago and it was $500,000. So that's my cost basis. Okay. You said cost minus depreciation. So property tax value, let's say it's $300,000, right? That's the value I'm paying my property tax on. You're saying if I go hire a contractor and build an ADU, and let's say it's worth $100,000, my cost basis now is the 5 plus the 100. So
the moment you pull a permit, Cory, correct me if I'm wrong, but so let me give you an example. In the old Southwest Reno, you could buy $1.5 million house, and the property taxes, John, are $125 a month. I've done one, $125 a month. The moment you go pull a permit to do an interior reconstruction or add-on, you're no longer at the $125. They're going to bump
what they do. But what they do, and in your example, John, it's not your cost basis. So like Dwight mentioned, you can spend $1 million, but if the house was built in 1920, it's depreciated back to 1920. Whereas if your neighbor spends $1 million on a brand new house, his or her taxes will be 10 times higher than yours, even though you spent the same amount of money. So it's the age of the house.
Original cost when it was actually built could have been 10
years
ago.
Depreciated back. So they depreciate it back to the time it was built. In Dwight's example, they don't automatically take you to the brand new thing. They do a blended. So if you look at the assessor stuff, sometimes they'll say like built in 29, but I can't remember the word they use, but like blended built in 1972 because somebody did an upgrade.
I see.
Halfway. So they don't take you to the full boat, but you lose the benefit of the long one.
So you will get a bump in your taxes. So you got to factor that in too. 100%.
That is a great point, Dwight.
Yeah. And the other thing too, Oh, go ahead. Before we get off it, if you're going to build one of these things to do short-term rentals, they are actively talking about, and they will come in and put regulations on them. So don't bet the family farm on making rental income, because it could change in a year.
Okay. Dwight?
Oh, no, Cory's right.
Just real quickly, Dwight, could you lend on that?
We're getting to that point now. Yeah. But right now, I think typically what you do is probably go get an equity line, because you're locked into, go get a nice equity line to cover the construction or whatever you can do there versus mess up your first.
All right. Well, I saw it as a big breakthrough, but like anything, there's pluses and minuses. Thanks, guys, for laying out the negative side of it. And I don't mean that in a bad sense. It's like, man, glad to know that now versus, someone getting excited and going out, like you said, betting the family farm on it. No pun intended. All right, we come back. You just inherited a house. Now what? We'll get to our topic, but first let's turn it to Jack Saban, who has news, traffic, and weather. Hello, Jack. Welcome back to the Jon Sanchez Show on Newstalk 780 KOH with Cory Edge of Edge, related to Dwight Millard of Highlands Mortgage. 243 loss on the Dow, down 19 on the NASDAQ, and on the S&P 500. All right, let's get to our topic that we started on Tuesday but ran out of time. All right. Great wealth transfer. Let's give you some stats to get this kicked off and refresh your memory. According to Sorelli and Associates, $84 trillion in assets are expected to be passed down through estates between the year of 2024 and the year of 2045. Of that, 16 trillion, there's that number, guys, $16 trillion is going to transfer within the next decade, and about half of the wealth is going to be tied to real estate, particularly in California, Florida, Texas, and other high appreciation states. 45% of Americans age 55 plus own their home outright, almost a half, meaning millions of properties are going to soon change hands. And then a Fidelity survey found that 1 in 3 inheritors sell an inherited home within the first year, often without understanding the tax implications. So to recap what we touched on Tuesday, you start with the reality, right? The emotional side. You just lost a loved one. Then you have to make major financial decisions quickly. The boomer generation, again, holds over 50% of U.S. household wealth. Much of it is tied up into the home. Point 2, immediate steps after inheriting the home. Cory did a phenomenal job on this, along with Dwight. Cory, I'm going to stop. I think I want them to hear it from you, because you're the expert in this. Talk about point number 2 when we get into the title and so on and so forth, because this is such a absolutely critical step.
So you need to make sure, first and foremost, how it's titled, how the property is titled. Did your parents have a trust? Do they not have a trust? Do they just have a will? If they do not have a trust, more than likely you're going to go through probate. As we talked about on Tuesday, I highly recommend, you can do it yourself if you want, but I highly recommend to get an experienced estate probate attorney to take you through the process, because you have to notify creditors. You got to notify Medicare, Medicaid, like we do. You got to notify all these different things and handle things the right way. You have to be named administrator. There's a bunch of different things, but probate in and of itself isn't a scary thing. It sounds scary, but if you get a good attorney, they can get you through there good. If it was held in a trust and you just happen to be the successor trustee and you are the person that is in charge now, you want to see who else is in there. You'll know who the other beneficiaries are. You need to make sure you give them a copy of the trust, and then you need to abide by the trust. Again, I recommend talking to an attorney. A lot of times it's the attorney's office that drafted the trust, if possible, because they'll know the most about it. Probably talk to a CPA at the same time to figure things out, and then notify the beneficiaries of how you're going to start taking the steps that are in the trust. But in both cases, just remember, this is all on you. You have fiduciary duties. If you make a decision that costs a bunch of tax losses for everybody else, guess who to foot the bill when they come back at you? You do. So you have the right to get opinions from experts and make those decisions, and just kind of go from there.
John, remember too, we covered a solution is not just to add somebody to the title too, because that changes everything too, right?
Yes, absolutely. Right. And then the final point on that one too, guys, you've got to get a hold of like the Richard Laces of the world. You have to get that appraisal done ASAP. The sooner, the better, to establish a new cost basis. So Cory, that takes us to point. Yep, takes us to our third point, understanding the stepped up basis. Could be a great thing, could have some downsides to it. Explain.
Yeah, it's most of the time, if it's a house that's been held forever, that's going to have a low basis, meaning your parents or the people that passed away paid a little bit of money for it. Now it's worth a bunch of money. Well, the stepped up basis is going to allow you to step their cost basis up to the date of their death. Then when you sell it, theoretically, if you sold it for the exact same amount, there'd be no tax due. If you sell it for a little bit more, you'll owe some tax. If you sell it for a little bit less, you'll have a loss. Doesn't matter. But Richard Lace and people like Richard appraisers can set that value. And John, I even hesitate saying this. You don't necessarily need that to file your tax return, but if you get audited, which a lot of times you will, you want it in your file so you can say, no, a third party told me what the value was. That's why I filled these things out the way I did.
The appraiser.
The other thing to remember too, I had this conversation with a client today, unfortunately, that people forget. If you're a beneficiary and you get an inheritance, that is your personal property. Doesn't matter if you're married. That belongs to you, period, outside of anything else. If you start commingling those funds with your spouse, you're walking a fine line of maybe that's not all yours. And it's also protected from creditors as long as it's not commingled. So if you get a chunk of money from an inheritance, talk to somebody so you understand what you should and shouldn't do with it. The other thing, and this caught me off guard a few years ago, and maybe it was common knowledge, but inheritance follows the bloodline. So it goes down, and it will, if the bloodline was a son and that son is now passed away, it will bypass the spouse and go to the grandchildren.
Absolutely.
So inheritance will follow the bloodline down. It doesn't automatically go to a surviving spouse if that person wasn't part of that bloodline.
However, in many times in life, it does go to that one. And hence why we always will talk to clients and say, make sure that you love your son-in-law, your daughter-in-law, and that you understand that if you don't have certain provisions in the trust, upon your passing, you want this money to go to, let's say you got a single child, go to your son, but all of a sudden you don't like his daughter-in-law. If you don't have certain provisions in that trust, guess what? That money could very easily go to the ex daughter-in-law.
Yeah.
So very important point, Cory. Very important. All right. So we want that stepped up cost basis. We have to get an appraisal to do that. Once again, we want to minimize the taxes if and when you decide to sell, or, at some point you will probably sell. Again, where this gets, as we wrapped up on Tuesday, where it gets really messy is if you have multiple siblings. Let's just say the siblings are the only beneficiaries. You have multiple siblings. Let's say you got 3 of them. Let's say Cory and I and Dwight are brothers. And I'm like, no, I want to cash out. I want my whatever, $300,000 worth. And Cory and Dwight are like, no, I want to keep this for a long-term investment. Then they got to figure out a way to pay me out, buy me out over time. They go get a loan. There's a million situations, but that always seems to happen. I find, I don't know about you guys, rarely do I ever find if there's multiple people involved as beneficiaries, does everybody agree? No matter what the trust says, they're like, okay, yeah, all this money's going to John, Cory, and Dwight. And then I can come out of the woodwork and go, you know what, guys, I know mom and dad are giving me my third, but I don't want it. I want the cash. I need the cash, right? I don't know about you guys, but I find rarely does the people into this, all the siblings end up keeping it. One wants to get out.
Yeah. And so when we get into that point, and I was having this conversation with our friend Richard Lace just a couple of weeks ago. If the trust says not to sell properties and keep them renting, then that's what you're doing, unless everybody can agree.
Yes.
But if there's multiple properties and 1 or 2 people need out, you have options. And what Richard and I were discussing in his particular instance was you may not need to sell the properties in order to generate some cash to pay these people.
That's right.
Maybe you sit down and you agree upon values and you deed one of the properties to the person, let them sell it, because there's tax implications all the way around. So if you are part of multiple people inheriting stuff and 1 or 2 want to sell, make sure you understand what your tax ramifications are if it happens. And then the trustees should be making sure what everybody's tax ramifications are on plan A and plan B, because it changes. There's different ways to get assets to and from beneficiaries.
That's right. And then it gets even more messy if you're talking about a rental property.
Sure. Yeah.
You got tenants and leases, and it's the whole thing. All right, let's squeeze this one in, guys. Or Cory, at least the kind of the theme of this 4th point. Should you keep it? Should you sell it? Should you rent it? So when we come back, Cory, I'd like you to run through the points. Things to remember if you decide to keep it, if you sell it, if you rent it. We're talking about, again, you just inherited a home, now what? With Cory and Dwight. Let's turn it over to Kristen Snow right now, Traffic Center. Hello, Kristen. Welcome back to the Jon Sanchez Show on News Talk 780 KOH. We have lost Mr. Millard. He had to step out for a meeting. If you'd like to reach him, of course, 775-240-2022. Mr. Edge, your phone number. Beautiful. Thank you, sir. All right, let's go to point number 4, Cory. Should you keep it? Should you sell it? Should you rent it? When we're talking about inheriting a home, take it away. What do we do about the keep it side?
If it fits into your lifestyle, I've seen estates before that have multiple properties, a manager's in place that runs like a well-oiled machine. If you don't need the cash right away, then a lot of people keep them because mom and dad made smart decisions and you can just continue collecting the cash.
Okay. Once again, multiple beneficiaries, multiple people inheriting this potentially could have a different objective, right?
Everybody,
again, back to our.
They could. The ones I've seen in the past, if you have multiple properties and you've created a really nice business machine, your trust is going to kind of dictate how that machine is going to be handled.
Yeah.
Usually.
I've seen that a lot on commercial property or
Yeah.
multifamily, right? Like an apartment building or something. Okay.
The other thing to remember too is if there's cash, you can cash somebody out with the cash. The other beneficiaries keep the property. There's different ways to take care of it.
Exactly. All right. What about the other option? Sell it.
If you need the cash, most of the time, John, this is the case. If you need the money, if you've got other high debts outside that you can take care of, if you've never been a landlord, if you've never wanted to deal with things, if you want to, I've had a lot of people over the years that are just like, I just want to have closure. I just want to be done with it.
Yes.
Move on. There's nothing wrong with selling the property. That's what it was intended for.
Right, exactly. And once again, just not to harp on this, if you have siblings or others that you are partners, I'll use the term partnership on this property or properties, remember, folks, life is short. If you can't get along, if you're fighting, maybe you didn't get along before mom and dad's death, and you're probably not going to get along now that you're quote business partners. Throw that into your consideration also. I've seen it where it starts off where, again, everybody hates each other and then they come together and go, hey, thanks, mom and dad. This is a great retirement source of income for us. Or just the opposite. Man, we were really close, but the old adage, blood's thicker than water. And I can't stand my siblings now because of this whole estate mess. So therefore, get rid of it all, right? So there's a lot of scenarios. But again, I think Cory gave some great advice. Look at your situation first, then you got to come to an agreement as a group. And if you can't, especially if there's only 3 of you, right? Can't have a majority, or you can't have a majority, but if there's 2 of you, can't have a majority there. Or if there's 1 of you, you can always, end up hiring an arbitrator or an attorney or somebody to kind of play that mediator role and go through the pluses and the minuses of selling it, etc. What about renting it out, Cory? Obviously an option.
It's always an option. With that one, I would definitely talk to a CPA, get the tax issues, understand what it would be if you sold it today, understand what it would be if you decide to keep it long term and what it might look like down the road. But again, if you don't need the money, if the other beneficiaries are in agreement, or if you're the single beneficiary, it created a nice base for mom and dad. So there's no reason it can't create a nice base for you.
Absolutely. Okay, we're going to wrap it up with a conclusion. We're going to call this estate planning lessons. Here's what we're going to advise on. Number 1, in most cases, always consult to a legal professional. Probably put the home in a revocable living trust to avoid the probate. Put the estate, obviously, in the living trust to avoid probate, right? That is your number 1 issue, the probate side of things, etc. Plus no specific instructions. So please, 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 parents, grandparents, if you're going to be letting your kids inherit your estate, it all starts with the living trust. Number 2, make your intentions very, very clear. Don't crowd it. Don't make it all fancy. Let the kids fight over what you, or don't let the kids fight over what you could have settled, meaning having a clearly defined trust, saying this is, like Cory's referred to, these are my intentions. This is where I want the money to go. Here's kind of the rules, etc. And remember, folks, if your property goes to probate, you could have a situation where no one can have access to mom and dad's bank account. Therefore, how are they going to pay property taxes, mortgage if there's still a mortgage, etc.? Living trust, estate planning, absolutely vital. And lastly, keep the property taxes and the titling strategies up to date. As Cory said, things are changing all the time. Just make sure you understand how the property is titled. And mom and dad, final advice I have for you: have a family meeting. Communicate this to your kids while you are alive. Don't let it be a big secret where everybody has to figure out what your intentions were once you're gone. Cory, wrap it up. 10 seconds.
I totally agree with all of those things, especially the titling. And we've harped on it a lot. If you're going to have a trust, which we highly recommend, set out how you envision this thing happening once you're gone, and make sure whoever you pick to follow those rules will follow those rules.
There you go. There you go. Excellent advice. All right, folks. We hope you enjoyed that and make your estate planning life a little bit easier through proper estate planning. Again, assemble a great team to do all this for you, and let the kids benefit from your years of hard work with your rental properties and home, etc. Great job, Cory. We'll do it again tomorrow on the Jon Sanchez Show. God bless. Have a great afternoon.